So here is an example of a plain vanilla interest rate swap. In previous diagram, I gave a specific company names, Starbucks and then HSBC and then Societe Generale. But in the textbook, they say company A, B. Let's go. So here we are. Company A, they can borrow at the fixed bond market at 5%. And then they can alternatively go to floating rate market and borrow at LIBOR rate. Perhaps this is like a HSBC. Firm B, they can borrow fixed at 5.5%. Alternatively, they can borrow at LIBOR plus 20 basis points. Okay, like Starbucks kind of things. Consider firms A and B. Each firm wants to borrow $40 million for 3 years. Okay, firm A wants to finance an interest rate sensitive asset and therefore want to borrow at a floating rate. A has good credit and can borrow at LIBOR, which is really like a bank's interest rate sensitive asset. That is nothing but a loan. I told you in the previous fictitious example about HSBC and then its loan to Rolls-Royce. That loan itself to Rolls-Royce will be an interest rate sensitive asset on their balance sheet. Okay? To finance this one, they want some floating rate borrowing. And firm B wants to finance an interest rate insensitive asset, which is just like a manufacturing or service company like Starbucks, an asset, and thus want to borrow at a fixed rate. Okay, so B has less than perfect credit and can borrow fixed at 5.5%. All right, so now what? Here, yes, and then if a firm borrows from their bank at 5% fixed and takes up the swap bank on their offer of 5.1 to 5.2, they can convert their fixed rate 5% debt into floating rate debt at LIBOR minus 10%, 10 basis points, right? Firm A, and then they can go to a bank, right, X, and then borrow money from there and then pay fixed interest rate 5% and then go to swap bank and try to pay LIBOR. And then all in all, A's all-in cost would be LIBOR minus 10 basis points if you do this math, which is 5% payment, 5% plus LIBOR payment minus 5.10% they have to pay to the swap bank. So this is what I mean by all-in cost, right? All in all. They have to pay like this by entering into a swap contract initiated by some swap bank. And if you look at company B, firm B, it borrows floating from their bank at LIBOR plus 20 basis points and takes up the swap bank to their offer of 5.1 to 5.2%. They can convert their floating rate debt into a fixed rate debt at 5.4 percentage point. Okay, 5.4 percentage point. B's all-in cost, right, will be LIBOR plus 20 basis points plus LIBOR, and then what is, I don't know, minus LIBOR and plus 5.2. Remember, whichever cash flow that goes out of the company, right, has to be plus sign, and that comes into the company has to be minus sign. LIBOR minus plus cancel each other out, and then 5.4 base the percentage point if you do the math. Now that's all-in cost of B. So the diagram wise, the swap bank, right? If you look at it, the swap bank makes 10 basis points on the deal, the swap deal, right? The LIBOR coming in and going out, that cancels each other out. It just passes through. But the fixed rate interest comes as 5.2 percentage point and goes out at 5.1 percentage point. So the difference of 10 basis points should be swap bank's income. All right, the swap bank's all-in cost will be minus 10 basis points, which is minus LIBOR plus LIBOR minus 5.2 percentage point plus 5.10 percentage point. Notice that is the cost. That's why minus means profit. Then how about company A and company B's payment, right? How much do they earn? How much do they earn? The notional size, notional principal is $40 million in this example. The tenor is for 3 years. Tenor is like the remaining maturity, okay? It's not the initial state, but in the middle of the borrowing, you can do this kind of swap transactions, right? So there could be some remaining maturity. That's the concept of tenor. I'm going to talk about it a little later again. Anyway, so this is a diagram that combines what we discussed before. If you look at, scroll down this presentation slide, you will see naturally it flows like this, right? It builds on the next paper, next slide. $40 million of notional principal, right? And then notional principal, 3 years tenor, right? And then and then combining left and right like this. And then A earns $40,000 per year on the swap, and B earns $40,000 per year on the swap as well. And then the swap bank earns $40,000 per year as well, right? By the way, tenor versus maturity on a loan. Well, for example, if a 10-year government bond was issued 5 years ago, then the maturity would be 10 years, and its tenor, the time remaining until the end of the contract, right, would be 5 years. In this manner, the tenor of a financial instrument declines over time, whereas its maturity remains constant, okay? Now, using a swap to transform a liability, it looks like this. The firm A, okay, the same example, the company A has transformed a fixed rate liability into a floating rate liability, floater. A is borrowing at LIBOR minus 10 basis points. Saving of 10 basis points happen, and if you multiply this 10 basis points to the notional principal of $40 million, that is nothing but $40,000. That's this guy over here, right? Now that's that. Bank, firm A, and then swap bank, pay LIBOR and receive 5.1%, and then you pay bank X 5% fixed. So the difference is what is it? What is remaining is LIBOR minus 10 basis points. And then previously you could have paid, this company could have paid into LIBOR only in the LIBOR market, but instead now they are paying only LIBOR minus 10 basis points. That's why you had a cost saving of 10 basis points. That's what we are trying to say. Company B has transformed a floating rate liability into a fixed rate liability. Okay. B is borrowing at 5.4%. Okay. And then a savings of 10 basis points. Now, the company B, right, borrows from bank Y at LIBOR plus 20 basis points. So that's why they have to pay LIBOR plus 20 basis points periodically. But they go to swap bank and then swap it into a fixed payment interest scheme. And then they receive LIBOR rate from swap bank. And then, so that's why if you net it out, then it's going to be, what is it? Plus LIBOR plus 20 basis points minus LIBOR, and then plus 5.2 percentage point. Okay. And then essentially these two guys cancel each other out. And then what is remaining is 5.4 percentage point. Okay. In our plain vanilla, right? What about the principal? Our plain vanilla interest only interest rate swap we did not mention swapping the notional principal, the 원금 thing, right? It could be the case that firm A exchanged the principal with their lender, Bank X, and the firm B exchanged the principal with their outside lender, Bank Y. But usually just the principal amount, we just keep it over there. We only talk about the interest payment, okay? Now the percentage wise, we got some ideas about the cost savings, all right? And then how about the cash flows in terms of dollars, right? Let's say in time point 0, which is the initial point of borrowing, okay? Let's say the tenor is equal to the maturity, right? Tenor is equal to maturity. You borrow, the companies borrow from respective banks, right? A from X, B from Y, as much as $40 million each, okay? Or as much as, and then assume that at the point of beginning of the swap contract, LIBOR rate happens to be 3 percentage point only. And then the swap bank earns, then what happens in the next 1 year, right? Then 1 year from then on, what happens is the swap bank earns $40,000 per year. And then the company A saves $40,000 per year relative to borrowing at LIBOR of 3 percentage point. And then company B saves $40,000 per year relative to borrowing at 5.5% fixed. Okay. So previously, even before considering swap opportunities, these are what they could do. Company A, they could only go to floating rate market and borrow at 3%. Company B, they could only go to fixed in borrowing market and then borrow at 5.5%. But as they enter into the swap transactions, they can save costs like this. So how does that work? Well, for company A, right? Company A, they have to pay fixed of what is it? The out of $40 million, they have to pay $2 million of interest amount, which is 5% fixed, and then they have to pay LIBOR rate of 3%. That LIBOR rate of 3% was determined 1 year before. Okay, at the beginning of the contract, the LIBOR was set, and it's been 1 year. That's why it is 3% times the $40 million. That's this guy, LIBOR interest payment, and then they receive the 5 point, what was that? This guy, 5.1 percentage point over here, right? That's why you have yeah, 2.04 million US dollars, right? Receive it. So if you compute the net interest payment, right? It is like 2 million minus 2.04 million and then plus 1.2 million. And if you compare that with LIBOR 3%, right? 3% based on the $40 million should be 1.2 million, right? 1.2 million versus 1.24 million. That's going to be $40,000 difference. That's the cost saving for company A. Okay, company saves $40,000 per year compared to the situation of borrowing at LIBOR 3%. And if you look at company B, it also saves $40,000 per year relative to the situation of they have to borrow at 5.5% fixed, the fixed market. Over here, what happens is that the company B has to repay or pay $1.28 million to bank Y, because that's LIBOR plus 20 basis points, right? Based on $40 million. That's this guy. And then they will receive $1.2 million from swap bank because they entered into a swap contract. And then in exchange, they have to pay a fixed amount of $2.08 million to the swap bank, right? If you do the arithmetic, right? 1.2 million minus, right? Negative 1.2 million, and then positive 1.28 million, and then positive $2.08 million, right? Then you will get what? Positive, positive $2.16 million, $2.16 million. That's still a cost saving of $40,000 because this firm had to pay, should have paid $2.2 million if it had gone into 5.5% fixed rate borrowing without swap contract, right? 2.2 million as opposed to 2.16 million, okay, if you do the math. So the difference is $40,000, and that's the gain, okay? And let's say 1 year afterwards, right? 1 year afterwards. So this is, if you draw a timeline like this, 0, 1, 2, 1, and then this is about this second period. Okay, second period. Of course, there's a fluctuating or floating rate interest going on. So the LIBOR rate has to be set at the beginning of the period, which is t equals 1. And at that point, let's say 1 year rate was 4%. Okay. Then, so 4% is a LIBOR. Everything that involves LIBOR or LIBOR plus interest rate has to reflect this 4% instead of 3% in the previous slide. And then whatever that is fixed rate stays the same. What's the result? The net cash outflow amount will change, but the cost savings will stay the same. Here, 3% rate, okay, and then 4% rate. The fixed amount of interest that you have to pay does not change, but the floating rate interest amount, okay, changes accordingly. 4% based on $40 million. That's 1.6 million US dollars for each arrow. And over here, 1.68 million because that's LIBOR plus 20 basis points. Okay, that changed. Yeah, there. Now, remember in company A, they should have paid at LIBOR, but with this, thanks to this swap transaction, what they have to pay is turns out to be what? $2 million plus $1.6 million minus $2.04 million. So that turns out to be $1.56 million of payment. And if you compare that to the LIBOR rate of 4%, the amount will be $1.6 million. Here, $1.56 million as opposed to $1.6 million. That tells us that you save the cost as much as 40,000 US dollars for company A. How about company B? Well, B saves the same amount of 40,000 US dollars per year relative to the situation of borrowing at 5.5% fixed. If you do the math, right? The net interest payment of the company B based on $40 million, 5.5% would say $2.2 million payment that you have to do. But over here, let's say it's going to be less than $2.2 million. I mean, $2.16 million will be the answer if you add those things, three things together. So that's plus $1.68 million minus $1.6 million. Those will be 0.08 $0.08 million, and you have to pay $2.08 million. So if you add this to $0.08 million, that's going to be $2.16 million. I told you before, it's going to be $2.16 million, which is $40,000 less than $2.2 million. That $2.2 million is the interest that the company could have paid if they had to borrow at fixed rate of 5.5%. All right. So both parties saved interest expenses the same amount, $40,000 each. Both are happy. Swap banks are happy as well. What about the situation if the interest rate increased to 5%? It's the same cost saving of $40,000 if you do the numbers, right? Could have been paying more if you did not go into the swap transaction. So that's the benefit of having the swap contract like this. Okay. So that's that. The next video we're going to talk about the currency swap. So wait for that. Thank you for watching.